Hey everybody, how you doing? Dr. Sam here again. I wanted to do a follow-up on a video I made not too long ago. The original video was on transaction analysis from a corporation standpoint. So before you learn debits and credits, and I thought I would follow up with doing the financial statements that are associated with it. So let me bring that screen up here real quick. So hopefully you guys can see it. And we did some transactions back when I did this original video. And at the end of the video, we concluded that cash had a balance of 6,200, accounts receivable 13,000, supplies 300, equipment 10 grand, notes payable ended up at 7,900, accounts payable ended up at 0, common stock 5,000, dividends 500, service revenue 20,000, and expenses, which was made up of rent of 900, advertising of 400, and salaries of 1,600, grand total of 2,900. And at the end of the video, we said, hey, if you know your revenues and your expenses, you can easily calculate net income. And the way you get net income is going revenue minus expenses. And the result is 17.1. So it's nice to be able to know what your net income is. But when you are in the accounting field, you want to make sure that you present it in a formal presentation. Kind of like, when you're writing a paper, you've got rough drafts, but ultimately you have to have the final draft and it's got to look pristine. You got to make sure you got your paragraphs in the right spot. Things are indented. You've got things that need to be centered. Well, the same thing in accounting. So what we're going to do is we're going to go through the three financial statements, the income statement, the statement of retained earnings, and the balance sheet. And those are the three things we're going to concentrate on here today. So what I did was I took these balances that you see at the bottom and I entered them into what we call a trial balance. Now, we don't know debits and credits yet, but this is an actual trial balance in debit and credit format. But again, you don't know that right now if you're watching this video. So these are just the balances from the previous sheet, okay? But when you get into chapter 2 of your accounting courses, you will learn about a trial balance, and these accounts are actually in the proper debit and credit columns, but we'll pretend we don't know that yet. So from this info, we're going to go ahead and do the financial statement. So the first one is the income statement. And when you do an income statement, there is a heading protocol that you have to follow. So whatever the company name is goes first. Then the second line is the name of the statement, which is income statement. And then the third line, you write this really long date for the month ended, for the quarter ended, for the year ended, whatever the time frame happens to be. This one's for the month ended May 31st, 2000, blah, blah, blah. Okay. Over to the right, I have in yellow the objective, the goal, the purpose of doing an income statement is to figure out the company's profitability. You want to know if they're making a profit or are they operating at a loss. So this helps you to do that. Now, we already know the answer. Remember from the previous sheet here, we know the answer is going to be 17.1, but we need to present it very nicely. So let's go ahead and do that. The first thing is we're going to look at this trial balance information or the answers from that transaction analysis, and we're going to enter the income statement items. I just happen to color code the income statement items in the same color that I have here for the income statement. And as you can see here from the original list, the revenues and the expenses are going to make it in here. I've already pre-entered the titles. We just have to put in the numbers. So service revenue is the revenue account for the business, and that is $20,000. Remember, revenue is when you do a job. Whether you get paid or not, irrelevant. So when you perform a service, that's when you actually record the revenue, right? So if I do a job in June, I record the revenue in June. If I don't get paid until September, it doesn't matter. The revenue gets recorded in June. Same thing with the expenses. You record the expenses in the period in which they were incurred. So I'm just going to copy over the expenses here. 900 for rent, 400 for advertising, and 1,600 for salary. So notice I have them listed here. Why did I put them in column 1? Column 1 is designed for itemizing. So when you have a list of more than one, we kind of enter them in the column before where we want to put the total. So with revenue, I only had one revenue account. it automatically went to the second column or last column. Because I had multiple expenses, I'm using column 1. If I only had one expense, I'd put that all the way to the last column, just like I did with the revenue. If I had more than one revenue, like, let's say we're a beauty salon, we could have waxing revenue, hair cutting revenue, tanning revenue, pedicure, manicure revenue. The list could go on and on. I could have like 7 or 8 revenues, and I would list each amount in column 1, and then I would need a line that said total revenue, and that's what I would put in column 2. Okay, so we've got our revenue of 20 grand. Now what we want to do is figure out what our expenses total up to. So let me just do a quick little formula here, so I don't have to take out my calculator. And it comes out to $2,900. Okay, so the expenses total $2,900. Well, look at what I have here in yellow. How do you figure out your answer? How do you figure out your profit? Revenue minus expenses. So that's what I'm going to do. So I'm going to take my revenue of $20,000. I'm going to subtract out my total expense of $2,900. Hey, there's that 17.1 that we saw earlier. So $17,100 is the net income. Now, that 17.1 we're going to use again. In fact, I made a little path, a little pink, little yellow brick road, little pink, red brick road. I don't know. That's hard to say. Anyways, the yellow rolls off the tongue, but the pink, not so easily. Anyways, so this 17.1 is going to be copied into the statement of retained earnings. That's ultimately where it's going. So I made like a little path here. So speaking of the statement of retained earnings, what is that? All right, that is a statement that shows basically, the net worth of the business in essence. So we're trying to figure out, how much earnings we had at the beginning versus what happened at the end, and figure out what happened in between. So the retained earnings is a very, very important answer, because that's the answer that'll get copied into the balance sheet. So kind of be aware of that. So we didn't have any retained earnings in our original list, so I'm starting out with 0. So when you have your Excel document in accounting mode, zeros automatically convert to like a dash, as you see here. Okay. So what we're going to do now is we're going to add in our net income answer from the income statement. Right. So there's that 17.1. Right. This is the formula I'm actually going to use. So we're going to take our beginning inventory. We're going to add in our net income. By the way, if I had had a net loss in my income statement, I would be subtracting that loss at this point. But I have a net income, so 0 plus 17.1 gives us that same 17.1. So if I had $3,000 as beginning retained earnings, then 3,000 plus the 17 would have been 20,100. Okay, so now we want to subtract out our dividends, and our dividends were $500. So I like to do all my little subtractions in red here. And now we can calculate our final answer. So the ending balance in retained earnings is 16.6. Let's change this to a generic year. All right, there we go. So at the beginning of May, we didn't have any retained earnings. Then we made 17.1 in net income, and 17.1 of net income makes your retained earnings go up, but your dividends make sure retained earnings go down. Right? So that's basically what we're trying to accomplish in the statement of retained earnings. So now we want to do the final financial statement, and that's the balance sheet. And I did my balance sheet in green. So let me take all these things here and turn them green so you know where they came from. And let's see, this was a light blue color. And let's put that in blue so you know where that's coming from. Put this one in green too. Okay, so basically all the pink ones went into the income statement. The light blue one went into the retained earnings, and these green ones are going to end up in the balance sheet. All right, so let's do the balance sheet. So the balance sheet, here's the purpose. You're trying to figure out, do your assets equal your liabilities plus your stockholders' equity at a specific date? So notice the date's different. Notice it just says May 31st, where the income statement and the statement of retained earnings said for the month ended, right? So the balance sheet doesn't care what happened during the month. The balance sheet just wants to know, hey, what are my balances right now? So let's go ahead and calculate that. So notice I have two columns, and in these two columns, I want to use column 1 for itemizing and column 2 for grand totals, like I did in the income statement. Okay, so I have more than one asset, so I definitely want to use column 1. So cash 6,200, accounts receivable 13,000, supplies 300, the equipment $10,000. So those of you that are more advanced in accounting, you know that this balance sheet's going to get a little bit more detailed as you go further. And we'll learn about current assets and long-term assets. And just FYI, cash, accounts receivable, supplies, those are current. Whereas equipment, that's a long-term assets. So down the road, we're going to be even more detailed in this balance sheet. But right now, if you're in the first chapter, first week of your accounting course, you don't know that information yet. So we're keeping things pretty simple. So at this point, I want to add up all my assets. And the total is 29.5. So that is the first magic number of the balance sheet. We are hoping that we can get the bottom half of the balance sheet to also equal 29.5, because it is a balance sheet, the word balance. You're expecting two sides to balance out. So let's go ahead and see if we can get the bottom to say the same thing. So notes payable, let's see, that amount was 7,900. Accounts payable was 0, if you recall. So I'm going to put a 0 and watch what Excel does, turns it into a dash. So my total liabilities are 7,900 plus 0, which obviously is 7,900. In my stockholders' equity section, I'm going to put in the common stock of $5,000. And now, remember that little pink brick road I made to help me go from my income statement net income and put that answer into my statement of retained earnings? Well, now my statement of my retained earnings, the statement of retained earnings balance is going to get transferred into the balance sheet, right? Boy, tongue-tied on that one. So we're going to take this 16.6 and we are going to put that 16.6 into the balance sheet. And now we're going to add those two stockholder equity accounts. And that gives us 21.6. At this point, drum roll, please. We're hoping that when we add 7,900 and 21.6, that it equals that 29.5 above. And ding, 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 it works. All right, we are in balance. So I hope that you enjoyed this quick video on how to do these 3 financial statements based on transaction analysis. All right, please subscribe. You know, I got some merchandise too if you're interested in that. You know, some of my goofy sayings, like stuff you're going to learn down the road. But hey, I hope you enjoyed this and continue watching my videos and let other people know that I'm here to help too. If you guys have any questions on, you know, certain material that you want me to cover, you know, send me a message. I'll be happy to, you know, see if I can do something for you. All right. And good luck in your accounting classes. And I wish you the best. All right. Take it easy, everybody. Bye-bye.